Ladies and gentlemen, the crypto space. We're live on a Monday, November 21st at 11:49 a.m. And everyone always wants to understand what the system is doing, why it's doing it, and the direction we're heading. So, highest of levels, there's no such thing as stability. It doesn't exist. I always say when you're talking about fitness, you're either gaining weight or losing weight. And especially as you get more micro on the time scale. Um, it's just there's no such thing as stability. It doesn't work like that. And it's the same thing with the financial system, particularly with regards to the amount of liquidity in the system. It's either expanding or it's contracting. And the current directionality indicates that everything is continuing to contract. And I see no reason whatsoever to think that liquidity will begin expanding anytime soon. Now, you have different types of liquidity. You have like U.S. mainland constrained liquidity, and then you have ROW, rest of the world liquidity. Now, how we got to where we are is a conversation unto itself, but what happened at some point, Eurodollars formed, and that was basically where the rest of the world was like, fuck you, US, you're not exporting enough dollars, we're going to create synthetic dollars. And, assets were deposited into international institutions, banking institutions, dollar denominated. So they were assets bought in whatever currency, but they were deposited in a dollar denominated form, and then they were leveraged, and so liabilities were created against those dollar denominated assets or assets that were dollar denominated upon deposit, and US dollars were borrowed. Now they're borrowed not in cash because there's just not enough cash, and we have a couple of charts that I'll show you how much cash there is. So you could be eyes on this as I discuss. So what happens is there's a dollar liability. Now the global financial system has gotten really good at shifting around liabilities, and ultimately that's what runs the entire global economy. It's not physical dollars, as there's only 5.4 trillion physical dollars in existence, period. This is the base money. Everything in the planet is, with regard to currency units, dollar currency units, is based on this total quantity of dollars, and the rest is leverage atop it using either credit domestically or internationally, using dollar denominated deposits to create liabilities against them. So during a deflationary period, liabilities are contracting. Debt is either being repaid or debt is being destroyed, default, failed margin call, so on and so forth. And that creates a complete distaste for risk. Obviously, it increases rational capital allocation, investment processes, so on and so forth. And that's predominantly where we are. It's what does it mean to invest in a deflationary environment? Obviously, we have great experience knowing how to invest in an inflationary environment where there's excess liquidity and there's irrational allocation to investments, where it's just free for all. And that's exactly what 2020 was, 2021. There was an excess of capital, and literally people invested in complete trash, complete bullshit, and that's not where we are. Now, to invest, it has to be into something that has the primary characteristics of survivability. Shit that's going to exist into the future. Now, that's obviously the question we want to think about. What exists going into the future? Is its actual enterprise things that are cash flow positive, that are not possible to be destroyed because of debt servicing obligations. They maybe have no leverage. Now, there's plenty of traditional enterprise that fit this criteria, but that's obviously markets that are not of my primary interest. We're here to talk about the crypto space, and in that regard, that is the market that interests me the most. I think it has the most potential. Now, why do I say that? So, the world is obviously dependent on natural resources, consumer staples, food, manufacturing, refining and mining, so on and so forth. So that's obviously the foundation of the global economy. But look at the United States. The United States exported all of its manufacturing base, like 90, just the vast majority of it, let's say. Now, the vast majority of the United States GDP is, I would think it's safe to say, is financial services. The financialization of the American economy has long occurred, or occurred a long time ago, and and that's where the vast majority of revenue comes from. So, what is financial services? The capacity to extend credit, which facilitates liability growth, liability expansion, increasing liquidity, leverage, and during a deflationary period, obviously, all of those markets are going to be impaired. There's going to be a lot of capital destruction. There's going to be a massive contraction in available liquidity. So, that's really what the crypto space is trying to figure out right now. It's a purely financialized emerging market is probably the simplest way I could describe it. You have a capacity for payment systems. MoneyGram's gone, Western Union's gone. This completely disintermediates that. Clearly, those companies are not effectively disintermediated at this time, or disrupted at this time. They still exist, but these types of systems are what would facilitate that deprecation. Um, so so basically, these are the types of products we're dealing with: payment transfer as well as credit systems. And the most interesting ones are enterprise and traditional finance that we do not have access to in traditional finance, that is kept from us and kept to large corporations and banking institutions. It's forex markets, market making. You're not a market maker on the floor of the New York Stock Exchange unless you have whatever frickin' licenses, or unless you're working with a particular brokerage house that has that kind of access. But with 2 clicks, you can be a market maker in the crypto space, and that is indeed a historic profession, a historic enterprise. Um, and this is the way I think about this emerging market. It's a purely financialized emerging market offering products and services that are completely consistent with traditional finance, that are iterative atop traditional finance because they offer access to functionality, systems, enterprise that traditional finance doesn't expose us to. They don't give us access to it. So, unfortunately, everything I'm talking about right now has nothing to do with bottom, has nothing to do with some sort of appreciation in the near term. But this is the way to think about what survives, what is meaningful, because there's still plenty of things in the crypto space, in this financialized emerging market, that are cash flow positive. And the most important thing is that there's zero debt with these protocols. These protocols have required no human resources. They operate unto themselves, and they require no intervention. They require no benefits. They don't have to be paid. They just will exist in perpetuity if they have the critical attribute of immutability. So what we've assessed is a capacity to identify crypto enterprise that is guaranteed to survive, uh, just just inherently, and that's meaningful. So what survives, in my mind, becomes base layer infrastructure, because what survives will have shown that it can survive this insane deflationary period that is going to continue to exist and is going to not stop. There's no stopping what's coming, and it's going to get so much worse. And what survives will build lendiness, because what survives shows consumers that are consuming these protocols and then purchasing equity in these protocols, that they have a capacity to continue to exist in the future. So what is the most important thing in the entire crypto space? The shit that survives. It proves lendiness, builds lendiness, and then what happens during when the liquidity cycle the rate cycle, which is just a precursor to liquidity starting to increase. Um, when we start to get more liquidity, and that facilitates more venture capital, more enterprise formation, more protocols being built. What are they going to want to do? When you have a new protocol, how do you get a new protocol off the ground? Nobody trusts it. Nobody knows what it is. It is very difficult to build a new enterprise, whether it's digital or traditional. So you attach yourself to names, you attach yourself to existing infrastructure, to attach to the lendiness, to attach to the narrative, to attach to the momentum, to attach to just the general sense of comfort associated with something that was able to survive such a catastrophic deflationary period. So this is a period of time for appreciating the shit that has a higher likelihood of surviving. This is not necessarily a time for capital deployment. Now, obviously, there's plenty of people that are going to want to deploy capital, especially to protocols, immutable protocols like Curve, which has breached the 50-cent support level. There's not even a support level. I guess you could say the previous low at 54 cents, I guess, was a support, but you know how I say it. Support is a position of weakness, and this weakness is being completely obliterated to the downside. But who's going to build in the future, and what are they going to build on? They're going to build on the goddamn AMMs, and they're going to build on the ones that are immutable. And that is the core of my thesis going into the coming years, 2023, 24, 25. Now, there's no sense of time horizon when liquidity starts to increase in the system, um, but it's surely continuing to drain, down another 0.36% for the week in the crypto emerging market, 144 billion, $144.72 billion worth of liquidity in the system. Now, this is meaningful. That's a tremendous amount of liquidity compared to where it started from. And we know that this particular emerging market has captured these dollar liabilities, and these dollar liabilities are capable via, a hop or two of purchasing consumer staples, and that's the most important thing. Probably one of the most meaningful things that come out of this cycle, this liquidity cycle, was the capacity to spend digital liabilities. Um, Either via conversion or the primary custodian of dollar deposits or dollar denominated deposits, which is Circle. Circle facilitates the spending of digital liabilities, probably the easiest. You're not going on Juno or BitPay and using Tether, but you can go on and via swaps. Well, you can pay with Ethereum and other stuff, but predominantly, I'm pretty sure that gets converted to like a USDC, and then the USDC redemption system is used to facilitate merchant payment. Which makes the most sense. So, highly deflationary. Let's take a look at M2 real quick. So, interestingly enough, M2 hasn't come down that much. 21.7, $21.739 trillion, and we're at $21.503 trillion, which is very interesting. Such a relatively small drop in M2 as compared to M0. M0 is almost a 17% drop. So 17% only took. So this probably highlights the degree of relative leverage, because these are total deposits, these are synthetic currency units, so on and so forth. Well, the dollar deposits as well as synthetic currency units, but these are pure dollar units, like actual physical, or at least whatever the hell they define base money as, is the core of all currency units for the dollar. And using these currency units, that props up the quantity of M2 currency units there is. And obviously, it gets more complicated because then you have bonds, which another form of leverage, used as collateral to prop up a $598 trillion OTC derivatives market. And it gets even more complicated when you talk about the size, the scale, and the scope of the total Eurodollar market, several quadrillion dollars, as talked about by Jeff Snyder. So all of this has deflationary pressure against it. I thought we were supposed to get the next tick on this chart. This is H2 of 2021. Where the hell is H1 of 2022? They were supposed to release on the 15th of November. Let's take a look. We should be able to find the calendar, release calendar. Derivatives OTC, H1 22, November 30th. They've been bumping it back 9 days. I look forward to seeing OTC derivative stats for H1 2022. Now, obviously, that's just January to June. Where the hell is H2? Obviously, the deflation has accelerated in the second half of this year. But these numbers will be very interesting. If you see a significant drop in total derivatives outstanding in H1 of 2022, we can only expect an even further drop in total derivatives outstanding in H2 2022. And, that would entail risk off, which would just confirm the deflationary directionality of the system. Very precarious market. Not this particular market, but obviously the crypto market for further depreciation. I don't expect bottoming anytime soon. Let's see who's in the stream. Dan's in the house. A pleasure. If next year will be relatively flat, besides VCRV, what's your set and forget strategy for other assets? Well, fortunately, cash has been withdrawn. I expect no investments in the short term, albeit obviously tempted, but I don't see any reason for this depreciation to stop. But really, the only two things on my mind for new capital deployment would be Aura, which is finally getting to interesting numbers, considering the cash flow that the protocol still has access to. 181, 170, 60, 150. It's getting even more tempting, but the directionality is going to persist. It's just going to continue to depreciate. That's the way the whole system is going to go, and that's including equity markets, which are still propped up by excess synthetic dollars, synthetic liabilities in the system that funds are forced to deploy natural flows, 401ks that are just they have to buy. But as layoffs start, there goes less 401k contributions, and there goes less of that organic flow or that mandated flow that they're forced to buy. So once this rolls over, that's just it's gonna induce even more fear and further perpetuate the directionality for a period of time. Quite decent period of time. Let's look at total liquidity, Arthur's chart. Liquidity has been holding, and as reverse repos come off, that's what aids this. But reverse repos have been relatively steady. It's still over 2 trillion. And considering QT and the balance sheet reduction, I would assume that as per the construction of this spread, the reason why liquidity has gone up is because of the reduction in the reverse repo as well as the drawdown in the TGA. Treasury General Account. So QT has been completely negated from a systemic liquidity standpoint, which is very interesting, which is why we haven't seen the wheels fall off yet. But the wheels are getting close, and this is just not something to be tempted by. You're going to be tempted by it, but you cannot succumb to temptation. You're just going to be exposed to further depreciation. Or not more VEFXS. There's too much regulatory concern for a larger size position. I'm very comfortable with the size of the position I have. It's set for 4 years, which means with the position size I have, I will see what the market is like. The software will be there. The state of the software is probably a little bit more in question as compared to increasingly immutable implementations curve. Aura has a variety of concerns, especially at the balancer level, with the mega whale, which controls just, if not the vast majority, of BAL, and period. That is a massive concern. But aside from that concern and what he's doing, Humpty, at the balancer level, the protocol makes transaction fees, and those transaction fees are allocated to hidden hand in the form of voting incentives, which exposes significant cash flow at the Aura level. So that is meaningful, which means Aura is a cash flow machine, which means as the price point comes down, the relative yield goes up. You're able to have a larger position of aura for the quantity of deployed capital. So aura is interesting, and it gets more interesting as the price goes down because it's a cash flow positive enterprise with zero debt. And so does Curve. So if I was going to go maximum contrarian, I'd probably allocate to what pays less, which would be best expressed on either the warden directly, 37. I go, what pays less? 37% is less. Whew. What a number. But then you go over to vote market and stake down, you can see that Curve has also deployed. It's paying out 38% on the money. And as obviously Curve goes down in price, these percentages, APRs, go up because the percent is based on the denominator, which is V Curve price. So the question there, in my mind, is further concentration or a bit of diversification. I mean, Aura pays just like 10 times as much. But then comes to mind as time goes on, portfolios tend to get more concentrated. So I shouldn't entirely dismiss my consideration for just buying more Curve, and it's going to exist, and CRV USD is going to deploy, and these are all very interesting, and you don't need exposure to everything, and sometimes it just takes one thing, one allocation, one investment to change everything. And if the crypto market survives, this is going to survive. And there's only a handful of protocols that will survive, and then everything builds on them, and that's all that matters. Is the lindiness, and that the new protocols that come out in 5-10 years from now are going to build on the shit that has the lindiness. They're going to build on the shit that survives. So overall sentiment as of right now is literally zero allocation. I mean, look at a gas price spike. This is certainly volatility to the downside. But with 93 GWE, let's take a look at Ethereum real quick. This thing's probably selling a bit. Is the FTX guy? Yeah, look at that shit. 11.13. Let's look at Bitcoin. I mean, Sarah's going to be in a heck of a pinch if this boy hits capitulation. There's a 13. He probably set it up so his leverage gets a little bit. The threshold of risk is at the 100 SMA in the monthly. I mean, that's literally the last moving average. That is literally the last technical anything that indicates support. I mean, it's off trend already. It's off log trend. Significant break to the downside. This historic break. This is a much more significant break to the downside as compared to 2020. Completely off trend. So maximum risk in the market. It's not time to deploy capital, but it is a time. Whoop, there you go, 15. Real time 15 on the stream, but this is a time to assess where you'd want to deploy capital. It's exactly what we're talking about. What has the potential to survive? Immutability. What has the reason to survive is cash flow positive. It offers credit systems. It offers transaction processing. It offers access to systems that traditional finance doesn't give you, which is Forex markets. And, you could, buy mining? Manufacturing. What is it? Fucking buy Amazon and Apple? Stupid shit. I mean, come on. You gotta have the capacity of mush to think that those are good investments. What do you think? They're at the bottom and they're a growing enterprise and you're gonna get 10x on your money on fucking Apple and Amazon. You ain't gonna get shit. You're gonna get nowhere with capital management. You get nowhere with capital growth. Oh my God. So that's why we have these conversations. What has the potential to be a meaningful investment? It certainly isn't. Certainly isn't Bitcoin. Ay, ay, ay. Tapsy's in the house. Raul, a pleasure. Gaffer, critical mass. Training a client, talking crypto. I should stop training her and sit down and watch this. So train the client, but we could diversify a little bit. Morning, happy Thanksgiving. Thank you. It's going to be a heck of a Thanksgiving this year. A pleasure. Hilda's in the house. A pleasure. Hope you're well. Angelo, Ricky, One Curious View. I'm going to try and catch the falling knife. No! Well, that's what you're doing. You're literally catching a falling knife, especially today with Bitcoin pushing below 15, below 16 into the 15 range, and Ethereum's down at 111. Wow. Did you look at that? Curves below 50 cents, or is well below 2 at $1.81. Expect further depreciation. There's no reason to expect appreciation. And if you have appreciation, it's going to be sold by people that already have it, getting a chance to get out. This is a bear market. The directionality will continue until capitulation. The trend doesn't stop and reverse spontaneously. It just doesn't happen. YS, it's a pleasure. Welcome. What's up, Noah? Rupert's in the house. What's your take on GBTC? Maximum risk. Um, I mean, if they blow up, there goes Bitcoin. Bitcoin's just going to be an absolute free fall, and Sailor will get liquidated. That'll be absolutely catastrophic for price points. Um, what? Where were you going to support at 3,000 on Bitcoin? Support at 3,800 on Bitcoin? Support at 1,100 on Bitcoin? I mean, that's where we're heading. And we're past previous all-time high. What are you going to get support on the previous resistance at 13.9, which is basically the 100 SMA? Absolute technical catastrophe written all over this, because then you go on the weekly and there's literally nothing. There's nothing. And the monthly is still relatively new assets, so you don't have significant moving averages on the monthly to go after. What do you get, the 50 SMA and the 100? Oh no, that is the 50. Where's that the 200? Give me 2 seconds. That is the 200 and the 100, and that's the 50, and that's the 10 up here. There is no 200. Still too new. Yeah, 200 is purple. You don't even have a 200 SMA on the monthly on Bitcoin. Interesting. Kathy Wood just bought 2.8 mil. That's a bad sign. Well, it's a contrarian indicator. Um, I mean, she's smart, but man, she's taking a lot of risk and has taken a lot of capital loss. James, when curve emissions expire in a few years, do you expect liquidity to move elsewhere? Curve emissions won't expire for, I believe, 100 years. Curve is going nowhere with regard to emissions. So quantitatively, what needs to occur is the appreciation of curve such that incentives, LP incentives, maintain meaningful percentages. So that's the criteria for potential significance or continued consumption of the protocol if the yield on LP deposits remains meaningful. So curve needs to appreciate into the future for that to occur. In that regard, obviously everything is speculative. We'll see what happens. But the most important thing I could convey on a day like this is not a day that you're deploying. This is a catching of a knife, but this is a knife that's going to cut. Systemic liquidity is poised to roll over. They're just going to keep doing QT, and there's a reason why they keep reverse repos going. They don't want that liquidity to get into the system and drive liquidity back up. You'll have you drop $2 trillion into the market, 6, 7, 8. You'll have a raging bull market if they fuck up the reverse repo operation and drop rates. And I mean, I believe isn't isn't the reverse repo rate less than short-term like T-bills? Um, so what's going on there? Why is the short and long curve not getting completely bought, which would be a steepener? And that would really cause risk off in equities as the bond market becomes increasingly favorable, because it'll be a bond bull market where the bond price is going up, up, and up, and yields are collapsing down, down, and down because the banks are buying everything. Risk all over this market. If we hit those numbers, that's when you know who's got the solid financial infrastructure behind them, as you mentioned earlier. No debt, solid backing. Well, no debt, and cash flow positive are attributes of survivability. There's other criteria that go into a protocol remaining meaningful into the future, but obviously that has speculative written all over it. But where we're at is really just trying to assess what the hell is survivable, not necessarily. We can't forward think too much. What survives is actually meaningful in future markets. So clearly that would just be speculation at best. Um, but I think the conversation right now is to really just try and assess what even has the potential to survive. Should a BTC, well, let me try and catch all of these questions. Wouldn't buying more curve go against the notion of not being overly concentrated in a single protocol? Yeah, but bear in mind, conviction leads to concentration, and wealth creation requires concentration. So while the vast majority of capital can be deployed to a single protocol, you're diversified with small potential asymmetrical bets. If the asymmetrical bets pull off 10, 100 X's, now all of a sudden the entire portfolio structure is changed. So that's 1% bet, 1% to 10% changes everything. So nothing I say is written in stone. It's obviously always a debate, a conversation. So, yes, it would be overly concentrated to it. But what is overly concentrated? Isn't overly concentrated warranted at times? It's certainly not an all-in concept because there's plenty of diversification, either be it cash or digital liabilities, digital stablecoins, digital liabilities. And obviously, there's other forms of diversification that I'm in possession of, which is real estate and gold and silver and equities and bonds for that matter. So it wouldn't so far from all in. Should a BTC have a floor price just below break-even cost for most efficient miner? Yeah, but that's when you capitulate the shit out of the miners. So there's plenty of reason for it to go below in a deflationary environment. The price action causes miner insolvency, and they're just not able to finance their outstanding debt servicing requirements, and they explode. And then there goes the hash rate, and then there goes the price point, because the price point historically has followed the hash rate. Do you think it's a smart idea for an ETF given the irreversible nature of blockchain? What happens if Block Swan occurs? What, a hack? Hundreds of billions of vapor. Well, that's exactly what happened in with FTX. Not necessarily. What's the difference between a hack and a fraud? A fraud is a hack in plain sight that no one even noticed. They literally hacked people's wallets, convincing them to deposit assets, and those assets were literally just completely mismanaged. So we've had the black swans, and the black swans continue to happen, and the black swans are happening in a completely deflationary environment, which is triggering liquidity crises all over the place and a complete inability to service debt obligations. In DeFi, at least, the debt obligations are managed by automated liquidation engines, which transfer risk from the infrastructure to the debtor. So the debtor assumes all risk. Their collateral is liquidated, which puts depreciative pressure on the markets, causing further cascading liquidation, but it obviates the protocol of risk because the protocol merely is just liquidating, 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 liquidating. It's not like they get caught with bad debt on their balance sheet. It's instantly liquidated at the time the margin call warrants. So it's very interesting in that regard. And that's survivability. It's going to survive. Plenty of shit is going to survive. And this is a very interesting, purely financialized emerging market that has products and services and enterprise that will survive and will continue to further depreciate as they continue to survive. Dan, JJ, a pleasure. Paul, are you familiar with the Stuxnet virus that infiltrated Iranian nuclear? I'm familiar with that. No, it's none. Well, yeah, anything could be hacked, but that's some serious far out stuff. I wouldn't be thinking about stuff like that. Um, I mean, obviously, a mining pool. If it depends on the mining operation and the risk exposure and their security operations, because obviously a Bitcoin miner could run off a daemon and literally only have a network connection to the Bitcoin network. It doesn't require TCP/IP to mining pools. So it depends on the security that a particular Bitcoin miner is executing. They could literally just be solo mining. If you have enough hash rate, what the hell do you need to contribute to a mining pool for? So that's interesting. But I don't think too much about that. Um, It would be probably a targeted attack. So obviously, with any hardware and software deployment for a miner, you got to have a security team, especially if there's hundreds of millions of dollars of hardware invested. So that's just something to think about. King, hello, sir. Can you incentivize? Could the incentivized nose make something in Q1 2020? I'm not quite sure what that means. Well, well, 2020 is long gone. So, there's plenty of no's, and L2s are interesting. I think the L2s, man, they spent a lot of time developing them. And obviously, like Polygon is quite used. Avalanche is quite used, and Phantom has a bad rap, but it's still quite used. So, what will they become? Are they necessary considering Arbitrum, Optimism, ZK Sync? Are they necessary? That's speculative. We'll see. Are they interesting? Yes. Are they meaningful? The market will tell us that. That's the bottom line. So I leave you on this Monday, November 21st, in a deflationary environment that's going to further depreciate. Be lucky and grateful, and please find yourself content with the amount of cash you have. Hopefully, it's cash in the bank as well as digital liabilities as well. Diversification with regard to bank liabilities or liabilities in general, digital liabilities. I think that's interesting and meaningful, especially given the fact that you could spend these digital liabilities. Juno's hot. You could spend them. Oh, King, you said 2022. Incentive notes make something. Well, incentive notes make something every day. Cosmos pays 20% of the money. The problem is it's depreciating 20% of the money. So the question you're asking yourself is what survives? It's the same conversation whether it's for an L2 or anything, or Ethereum. Let's take a look at the two big boys in crypto before we leave. 1,111 and Bitcoin's at 16,037, just hovering around the 1,600 mark, 16,000 mark. All right, it is what it is. This is going to be another week of boredom and just monitoring and trying to restrain yourself from making an irrational decision. Just remember, cash flow, enterprise, real yield is the thing that's going around, but that's just basically traditional value investing methodology, shit that actually has a purpose and is cash flow positive, has a higher chance than less of surviving, and that's what's most meaningful. Be restrained. I'll see you guys on Discord, and we'll make rational decisions together. Monday, November 21st at 12:27 p.m. I thank you all for joining me today. Tell everyone to subscribe because I can't help anyone if they don't listen to me. After party on Discord for the most rational community in the entire crypto space. Can't say it enough. I appreciate everyone in there. We will do better together. See you guys on Friday. Peace.